Hello everybody and welcome to chapter number 7, Production and Cost. If you remember the previous chapter, we talked about consumer choice and consumer behavior. It was basically a maximization problem where we had to see exactly what consumers were trying to maximize given to a particular constraint. In this particular chapter, we're going to do a very similar task except focus on the firms and corporations just a little bit more. So what is the firm's main purpose in life? What are they trying to maximize and what is their constraint? So it's going to be a maximization problem on the supplier side. We'll also delve a little bit deeper into the firm's sort of idiosyncrasies and a few concepts that are going to be seen on the supplier side only. And the things that we learn in this particular chapter are going to lay out the foundations for our next 3 sections, particularly with firm structures. So things like perfect competition, monopoly, oligopoly, monopolistic competition. The things that we learn in this particular section are going to be very, very applicable as we progress through the rest of the semester. So as we start off this particular chapter, we're going to go ahead and just get a little bit into the sort of general business ideas, see exactly the different types of firms, the differences between accounting and economic profits. So once again, we're dividing things up on the economic, accounting, finance sort of sides. And then we're going to go ahead and take a look at how firms actually bring things out into the marketplace. So how exactly do they bring out this type of product, these type of goods? And we take a look at a few different concepts known as product or production. But of course, we do know that there are going to be some differences in the short run and the long run, as we've already noted in the past. And this differentiation, this time differentiation, is going to make firm decision a little bit more complex because things will differ from the short run compared to the long run. And we have to go ahead and take a look at the cost, of course. So if firms want to bring out product into the marketplace, if they have some type of production, they are going to be incurring some type of cost. So what are all the different types of costs and exactly what do they look like graphically? And of course, things will look differently compared to the short run and the long run, and we'll get into all of that. The first thing that we want to go ahead and do is just talk about what a firm is. And firms are an economic institution that transforms inputs to goods and services for consumers. So a very basic definition of what a firm is, and there's a lot of examples of firms that we can think about. There's Amazon, there's eBay, Walmart, Target, Publix, you name it. These are all considered firms. However, we can even get to a very, very micro example, very, very simple examples that would still fit the definition of a firm. So suppose that the guy walking down the street selling fruit, churros, and other type of flowers or other type of goods, this could actually be considered some type of firm because he's transforming some type of inputs to goods and services, and we as consumers could potentially buy this particular product. So yes, that one individual person selling these random products on the street can be considered to be a firm. And firms themselves, whether they be large, complex, or very simple, they have to make a lot of decisions and ask themselves a lot of questions. So let's go ahead and delve a little bit deeper into this. So firms are going to make a lot of numerous decisions. Firms make numerous decisions. So even before a product comes out into the marketplace, a firm has to ask itself a lot of things and it has to make a lot of decisions for itself. The first thing that might pop into your head is, what exactly does it want to sell? So determines a market need. So determine a market need. So what exactly does the economy or the marketplace want? Obviously, if you are selling a good or service that nobody wants, you're not going to be in business very long. So you as a firm, big firms, small firms, they have to identify what the market wants and match what the marketplace actually requires. Once they require a market need, they're going to go ahead and have to ask themselves what to produce or how much to produce it, how to produce this particular good. Remember, we require some mixture of our factors of production, and this right mixture of factors of production is going to tell us exactly how to produce this good or service. And of course, not exactly how to produce, but also how much to produce. So how to produce and how much to produce. So do we want to flood the market with this particular item, or do we just want to hoard it a little bit to sort of create some type of scarcity and raise the prices? So there's a lot of different decisions and questions the firm has to ask itself when it wants to go ahead and provide a good or service out into the economy. One of the most important questions that a firm has to ask itself as well is exactly how exactly does it want to set itself up? What type of firm does it want to structure itself as? And there are 3 different types of firms we go ahead and take a look at in this particular section, although there are a little bit more in application. And the 3 different types of firms we take a look at are the sole proprietorship, the partnership, and the corporations. And the way a firm is going to sort of designate itself is a very, very important decision it has to make, because there are pros and cons, advantages and disadvantages to each of these types of firms. So let's go ahead and delve a little bit deeper into each one of these and see what those are going to be. First, we focus in on the sole proprietorship. So sole proprietorship. Sole proprietorship. In the sole proprietorship, this is essentially going to be the backbone of the United States. The vast majority of businesses nowadays within the US are sole proprietorships. They account for nearly 70% of all businesses in the US and about $1.5 to $2 trillion in sales every single year. And what is a sole proprietorship? It is comprised of only one owner. So comprised of one owner. One owner, not a D right there. So it's comprised of one owner who supervises and manages, the business and is subject to unlimited liability. So who supervises and manages the business and is subject to unlimited liability. And unlimited liability, we'll get into this very, very shortly. It's going to be one of the major disadvantages of setting yourself up as a sole proprietorship. So just go ahead and do a thought process right here. Why would anyone ever want to set up their firm as a sole proprietorship? So here we take a look at a few advantages of a sole proprietorship. The major advantage of a sole proprietorship is it's going to be very easy to start. Very, very easy to start. So like we said, the vast majority of businesses in the US, about 70% of them, do set themselves up as sole proprietorships because they are very easy to set up, very little paperwork involved, very little government intervention. Just sign a few forms and boom, you can start your own business. So we can think about these, the mom and pop shops. These are essentially the backbone of the United States. We also see that there's going to be a lot of flexibility with the sole proprietorship because it's very easy to start it. So very easy to start. There's a lot of flexibility as well. So you want to be your own boss. We can put it that way. So be your own boss. So there's a lot of flexibility. You want to be the boss. You make the decisions. Everyone has to go through you. So essentially here, this is the major advantage, a major selling point of a sole proprietorship. We also see that in terms of sole proprietorships, it typically has lower costs compared to the other types of firms. So we can say lower cost as well. And there can also be some type of tax implications too. So tax implications. And essentially this gets into the sort of the idea of money as well. Because there is only one owner in the sole proprietorship, you essentially get all the profits in this case right here. So one owner gets all of the profits, and that's going to be another major selling point of the sole proprietorship. However, we said that there is a very big disadvantage that comes with a sole proprietorship, and that's going to be this unlimited liability. So here, we'll put the disadvantages right here. So disadvantages. And the disadvantages, the major one, we're going to bring this all the way over here. That's going to be the unlimited liability, which just tells you that you are liable for all of your debts. So liable for all debts. And that just means not just for the business, but if your business can't cover these particular debts, the debtors can actually go ahead and pursue your personal assets as well under some circumstances. So we also notice that, hey, your personal assets can be taken. So your house, your car, your dog, your pets, basically, if you can't match up with your debts, or if you can't basically cover all of your debts, then the debtors can potentially go ahead and take your personal assets or file a lien against them. And also in terms of the sole proprietorship, it's going to be having a very limited ability to raise capital as well. So that's going to be another disadvantage that we have there. So you also have limited ability to raise capital. So if you need some type of financial capital, some type of money, banks, other types of investors are not as willing to lend to sole proprietorships as much as they are to other types of firms. So here, example of a sole proprietorship, we have a lot of examples, but just for a specificity right here, we can say that suppose that you've done really well in your economics course, and you want to set up your own economics tutoring business, that's perfectly fine. Major selling point, you can start it right away. There's really no red tape or bureaucracy involved with that. Very easy to start. However, you are going to be subject to unlimited liability. So suppose that you have a very short temper, and when you are tutoring one of your students, you get really, really frustrated at them because they don't understand something that you are teaching them, and you decide to hit them. Congratulations. What happens there? You are now bankrupt, and a lot of your personal assets can be taken away from you. So here, just an example of the sole proprietorship in application with the economics tutoring business that you want to open after the semester is over. The second way, or the second type of firm that you can sort of set yourself up as, is going to be the partnership. And the partnership has a lot of similarities as the sole proprietorship, except there are going to be a few differences with that. So the partnership. So the partnership, like the name implies, it's going to involve more than one owner. So it's similar to a sole proprietorship, but involves more than one owner. And the key word here is more than one owner. It doesn't have to be just two people. It can be 3, 4, 100, 500. It just has to be more than one owner in this particular setup that we have right here. And what are a few advantages of a partnership over the sole proprietor? Well, this is exactly where you have some type of division of labor. So you have advantage right here. Advantages. Major advantage that we have with a partnership is going to be some type of division of labor. Meaning that, hey, because you have more people under a partnership, you can focus in on the tasks that you are proficient at, while your partners are going to focus in on the jobs that they are good at. Under the sole proprietorship, who had to do everything? It was you, because there's only one owner. So you have to do task A, task B, task C, and all the way down the line. But under a partnership, you can have some type of division of labor where you focus on the job that you are going to be good at. Another example, or another sort of advantage under the partnership, is it's going to be slightly easier to raise capital. So if you need some type of money, you can go to the banks, and banks are going to be a little bit more willing to lend money to you under a partnership rather than a sole proprietorship, because there are more people involved. It's going to be spreading the risk. So here, just because it's considered to be a little bit less risky to lend money to more people rather than just to one person, you are going to be having a little bit of an easier time to raise money. However, another disadvantage, the same disadvantages hold true here as it did under the sole proprietorship. So disadvantages. The major one, of course, still going to be this unlimited liability. So unlimited liability. And the unlimited liability here becomes an even bigger disadvantage, because not only do you have to worry about yourself, your own actions, but you have to worry about your partner's actions as well. So just continuing on with our economics tutoring sort of business example, suppose that you decide to open up an economics tutoring business with your best friend who's also in this particular class. But what happens if your friend has a hot temper now, and your friend decides to strike the student or hit the student that he or she is tutoring? You are still going to be liable for your partner's actions. So here, once again, your own personal assets could be potentially taken away from you, even though you didn't do you weren't the one hitting the student, it was your partner. So once again, unlimited liability is going to be a very huge disadvantage in both of these types of firms. And because this unlimited liability is such a huge disadvantage, we notice that a lot of firms nowadays do set themselves up as the third type, which is going to be a corporation. So corporation. And the corporation, it only makes up about 20 to 30% of businesses within the United States, but accounts for nearly 30 to 40 trillion dollars of sales every single year. So here, even though it's a very small percentage, it is where the vast majority of sales within the United States do come from. And why do people like to set the firms up as a corporation? Essentially because it has the most legal rights. Essentially, in the United States, a corporation is seen as a legal entity, and it's basically seen as a person because it does have a lot of legal rights. And also in terms of the corporation, one major selling point is that it can actually go ahead and issue stocks and bonds. So it can issue stocks and bonds. And that's going to be one of the biggest selling points that we have right there, because stocks and bonds are a very quick and easy way for firms to raise financial capital. So here, if they need money right here and right now, they can go ahead and issue stocks and bonds to get that type of money. So here, take a look at the advantages versus the disadvantages. So advantages. Major advantage is going to be, of course, this limited liability. Limited liability. So with limited liability, this contrasts with unlimited liability, and that fact that limited liability says that you are only going to be liable for how much you put into this particular business. The amount of liability you incur is limited to what type of money or how much money you put into this particular corporation. So here, the amount of liability is limited, like the name implies, to what you put into the corporation. To what you put into the corporation. So here, limited liability, amount of liability is limited to what you put in the corporation. Your personal assets cannot be taken if you form a firm as a corporation in this case. So suppose that you decide to put in $10,000 in order to form this economics tutoring business. That is the most that you can lose in this venture. $10,000, not a penny more, because a corporation does have this advantage of having limited liability. As we also notice, another advantage is going to be a very easy time to raise capital. So we can put that here as well. So easy to raise capital. And that's going to be done through these stocks and bonds. That they're going to have a much easier time if they want to go through the banks as well to get some type of loan. So another huge advantage there. But there are going to be a few disadvantages with corporations as well, which we can go ahead and talk about for completion. So disadvantages. And the major disadvantage that we see right here is that there's going to be more paperwork and cost involved. So more paperwork and costs involved. So if you want to go ahead and build up a corporation, there is a lot more paperwork involved. You have to have a lot of paperwork. There's going to be a lot of signatures. There's going to be a lot more costs involved compared to the sole proprietorship or the partnership. So there's a lot more time and effort involved into forming your own corporation. There's also some type of double taxation. So if you want to go ahead and issue some type of stocks, the dividends are going to be taxed doubly. So once again, there's going to be that is another sort of disadvantage that you take a look at. We'll put that down, double taxation. Something that you'll talk about in your accounting classes as well. But the vast majority, essentially what we have right here, the vast majority of advantages that we do get under the corporation far outweigh the disadvantages, which is why nowadays most people should be forming their firms as a corporation. And there's a lot, as we do notice, the vast majority of examples of firms that we see nowadays are exactly that. They are a corporation. So Walmart, Target, Amazon, eBay, Publix. If you can name a company that you shop at today, they probably have formed themselves as a corporation. But there are going to be a lot of unusual cases of firms or sort of other organizations that do set themselves as corporations because it does have all these advantages right here. One unusual case is actually going to be a football team. So how many of you have actually wanted to own a football team before? And probably not a lot of you, because you're probably thinking about the Dolphins in Miami and they kind of suck. But essentially here, there is one football team that has actually set themselves up as a corporation, and that's going to be the Green Bay Packers. So the Green Bay Packers are a nonprofit corporation. They actually does offer stock every now and then in order to do whatever they want with that type of money. The last time they actually offered stock was in 2011 because they wanted to renovate their stadium, Lambeau Field, and they offered about 269,000 shares of stock at $250 a piece, and they sold out very, very quickly because Green Bay Packer fans are very, very crazy. There's nothing to do in Wisconsin except for beer, cheese, and football. They're the kind of fans that basically sit in the middle of a snowstorm, half naked, just watching football. So here, they had 250,000 buyers, and they were able to raise nearly $64 million in order to help renovate Lambeau Field. It's kind of a nice stadium. It's an old stadium if you've ever been there, but also a pretty good experience. And as you can see, it's probably one of the worst stocks to actually own if you actually want to go ahead and own it, because there's not a lot of advantages for you as a sort of individual investor. The price of this $250 stock is never going to appreciate in value, so you're never going to gain any type of profits if the Green Bay Packers win the Super Bowl or if they win their sort of championship. it's essentially going to be the same price, $250. The only advantages that you get for holding onto the stock is that you can basically say that you are part owner of the Green Bay Packers, of this football team. You get a paper certificate that says so. You get the ability to attend shareholders meetings every single year, because if firms do issue some type of stock, they have to have a shareholders meeting every single year, and you have the ability to purchase shareholder only merchandise. So probably one of the worst stocks to own as an individual investor, but it gives you a good story to say that you are a part owner of a football team. And if you've ever wondered how crazy Green Bay Packer fans are about their team, take a look at their waiting list for season tickets. In order to get season tickets for the Green Bay Packers, you have to wait roughly about 30 years just to get them. So what a lot of people do in Wisconsin is basically once they have a kid, they put their kid's name on the waiting list for season tickets, and basically 30 years later, that kid will have ability to purchase season tickets. It's basically how crazy crazy fans are in Wisconsin about their Green Bay Packers. As you can see right here, the Dolphins, they have no waiting list because, as usual, our teams kind of suck every single year. But basically, this is basically what we sort of detailed right here are the advantages and disadvantages of all three of these firms, these three types of firms that we have right here: the sole proprietorship, the partnership, and the corporation. And we do notice that nowadays most firms are going to be setting themselves up as corporations just because of this major advantage that is going to be protected with limited liability. With all of this in mind, we want to go ahead and see what the firm's sort of profit maximizing sort of condition is going to be. So what exactly are they going to be sort of maximizing? We'll go ahead and take a look at that in the next few sections. I'll see you guys there.